In 2019, investors believed one company was worth $47 billion. Not 47 million, 47 billion. The company wasn't even profitable. It wasn't even close to profitable. In fact, it was losing money at a breathtaking rate, yet some of the smartest investors in the entire world couldn't get enough of it. Then almost overnight, everything fell apart. A planned IPO turned into a public disaster. Investors fled, the CEO was forced out, and tens of billions of dollars simply vanished. So how did a company that rented office space convince the world it was the future of work? And what happened when investors finally looked behind the curtain? This is the fall of WeWork. The story begins in New York City. In 2010, Adam Neumann and Miguel McKelvey launched WeWork. On the surface, the idea was simple. Rent large office buildings, divide them into smaller workspaces, then rent those spaces to startups, freelancers, and small businesses. The timing seemed perfect. The startup boom was exploding, remote work was growing, entrepreneurs wanted flexibility, and WeWork offered something traditional offices couldn't: community. At least that was the pitch. But Adam Neumann wasn't selling office space, he was selling a vision. According to Neumann, WeWork wasn't a real estate company, it was a technology company, a platform, a movement, a company that would fundamentally change how humans worked, and investors loved the story. As WeWork expanded across the globe, investors poured in money. Hundreds of millions became billions, then came the biggest supporter of all, SoftBank. Through its massive vision fund, SoftBank invested billions into WeWork. The company was suddenly growing at a pace few businesses had ever attempted. New locations opened everywhere. New employees were hired. The company entered city after city. Growth became the goal, not profit, growth. And for a while, it worked. The valuation climbed 5 billion, 10 billion, 20 billion, eventually reaching an astonishing $47 billion. But beneath the headlines, a problem was quietly growing. Here's where things get interesting. Most people assumed WeWork was a tech company. It wasn't. Not really. The company signed a long-term leases on office buildings, then rented out those offices on much shorter agreements. That meant WeWork had obligations lasting years, but customers could leave much sooner. If demand slowed, WeWork would still owe landlords enormous amounts of money. Imagine signing a 10-year apartment lease, then trying to rent it to strangers month by month. That's essentially what WeWork was doing. And it only worked if demand kept growing. Forever. As the company grew, Adam Neumann became larger than life. Employees described him as charismatic, visionary, almost celebrity-like. But warning signs started appearing. Reports surfaced about extravagant spending, private jets, lavish parties, questionable business arrangements. At one point, Neumann personally owned buildings that WeWork leased for him. Then there was the trademark incident. Adam Neumann trademarked the word "we," then sold it back to WeWork for millions of dollars. Investors overlooked these issues because the company kept growing until they couldn't ignore him anymore. In 2019, WeWork filed paperwork to go public. This document changed everything. For years, private investors had focused on the dream. Now public investors could see the numbers, and the numbers were ugly. Massive losses, billions in obligations, complex governance structures, conflicts of interests, questionable leadership decisions. Suddenly, the story looked very different. The market began asking a simple question. Why is this company worth $47 billion? And nobody had a convincing answer. The IPO quickly unraveled. Investor confidence disappeared. Valuation estimates collapsed. $47 billion became $20 billion, then 10, then less. The public offering was canceled. Adam Neumann stepped down. The company entered survival mode. Within weeks, one of the hottest startups in the world had become a cautionary tale. But the collapse wasn't caused by one bad quarter or one bad decision. It was the result of years of investors rewarding growth while ignoring fundamentals. Today, WeWork serves as one of the most famous examples of startup excess. A company convincing investors it was revolutionizing work, when in reality, it was a real estate business struggling to make money. The lesson isn't that big visions are dangerous, it's that stories can become so powerful that people stop asking basic questions. Questions like, how does this company actually make money? What happens if growth slows down? And who benefits when nobody asks? Because eventually, every financial disaster leaves evidence. You just have to follow the paper trail. If you enjoyed this investigation, there are plenty more stories hidden in the numbers, and we'll uncover them one by one.